welcome. It is nice having you here, and we have a lot to get to as we're going to be talking about what is to come, the expectations for the fall of 2022. I almost said 2023 here, but we're not quite there yet. We're still in the fall of 2022, and there's still a lot that's happening with respect to the stock market, the economy, and a lot of other aspects. That is what we're going to be talking about today. So we're going to get a little bit into the economy, a little bit into the Federal Reserve and inflation. We're going to be talking about other countries and their economies. And then lastly, we are going to be wrapping up with one question for you. So that is the agenda today, and what I really do want to reiterate here is that all of what we do here at Lions Wealth Management is to talk about how we can be looking in the lens of risk management. So when we risk manage our investments, when we risk manage our portfolio, all of that comes back down to saying, how can we take the least amount of risk and have the correct growth to match your objectives? Now, right now, we look no further than the Federal Reserve. Now, I know that this is not your favorite topic to talk about the Federal Reserve, but we need to understand why they are doing what they're doing and the implications of what that means for the economy. So let's take a look at this. Let's think about what the Federal Reserve is doing in the lens of an interstate. Now, we have a 3-lane interstate, not too big, not too small. You can still have traffic moving in and out, and it works okay. Well, in 2020, post kind of this COVID lockdown, when we had all this stimulus that was happening, and into 2021, when we had more stimulus that was being added in, think of that highway, instead of 3 lanes, it was expanded to 8. So now we are driving on an 8-lane highway with enough traffic for 3. Well, what happens when you have a lot less traffic on the road because you have a lot more road to work with? You can go faster. You can drive faster. You can have a lot of things that are happening faster. Well, that is exactly what's happened to our economy. So in 2020 into 2021, we had this expansion that happened, and that expansion allowed us to go faster. So we grew our economy faster. We started to employ people more. We started to see housing prices go up. We started to see all of these things happen. Well, now the Federal Reserve started to question that. They said, well, we've given you an 8-lane highway and we're starting to see the hardships of that. So yes, we can go a lot faster, but is that necessary? Do we need to be going this fast? And in fact, when we take a look at, well, whether it's car prices, whether it's housing, whether it is inflation of food or gasoline, the Federal Reserve is starting to say, no, we should not be going this fast. So what the Federal Reserve is starting to do, and coming into 2022, they really start to say, all right, well, instead of those 8 lanes, let's start paring it back. Well, they're doing this, and let's equate it to road construction at this point in time. So when we came into 2022, into the start of this year, we had an 8-lane highway, and then the Federal Reserve started to put some traffic cones on either side of that highway. So that what that meant then is that they restricted the shoulders. You couldn't drive on the shoulders or be part of the shoulders. Didn't really do much. You don't really look at that construction and say, geez, that's going to really cause me headaches. No, it didn't. Because we can still go fast. We can still be driving fast. We don't have to worry about those cones on the side of the road. Well, that was coming into this year. Now, over the course of the summer, they have started to take a look at this and say, instead of 8 lanes, and we've taken away the shoulders, now we're starting to say, instead of those 8 lanes, we really want to be paring it back down to those 3 lanes that the economy has been in. And we're trying to rein in that inflation. So the speeding that has been happening. So what they have done is they started to narrow the road by road construction. So they're starting to say they're taking away lanes 8 and lanes 7, 6 and 5. And they're doing this on a monthly basis. So it's not necessarily all at once. What used to be an 8-lane highway became a 6-lane highway back in July. Well, that has now become a 4-lane highway as they've restricted it even farther. So now you're starting to feel this a little bit more. We can still be growing the economy in the same way we can still be going on an interstate, but it's not the same way. We can't go as fast because traffic has been condensed into fewer lanes. So we're not traveling as fast. Well, that's one of the big things that you should be aware of what the Federal Reserve is doing. The problem is that there are some people that are still able to sneak through and drive really fast. So we've all known these people that everyone else is going the speed limit, and they seem to be doing 30 miles over the speed limit, and you look at them saying, geez, how stupid can you be? Well, on their standpoint, they're saying, I want to drive fast, I want to go fast. That's inflation right now. We're still having those people weaving in and out of traffic in the midst of this construction zone while everyone else is slowing down. They're still going fast. So the Federal Reserve is looking at that and saying, we don't want that to continue. We're going to continue to restrict the roads so that everyone has to slow down. Well, that is inflation that has been going out of control at this point. They want to start narrowing it down. They start reining it back in. What does that mean then? If we slow down, that means a lot more hardships. That means a lot more anxiety. That means a lot more frustration that crops up on drivers of an interstate. But the same is true on drivers of the economy. A lot more frustrations creep up. That is what the Federal Reserve is doing. That is why they're doing it, to combat the inflation. Now, what is that actually doing to our economy? It's slowing it down. So when we take a look at the slowdown that's occurring, and don't get me wrong here, the Federal Reserve is still going to be, well, constricting the growth. They're going to be moving those construction cones in to narrow the road more. And the whole thought coming into August was that the Federal Reserve was going to widen the roads back up again. That they're going to say, you know what, we can't be doing this. We need to widen the roads, let people move about freely. That may not be the case because all those speeders are still there, and the Federal Reserve really wants to get rid of those speeders. So, like I said, what does that mean for our economy? Because that's the big deal now. So when we take a look at the way that the Federal Reserve is restricting everything that is going on by reducing the lanes that our basically economic highway can be traveling upon, they're in essence slowing our economy. So that's a big piece of it. They're going to be slowing the economy because they have to in order to make this happen. Then the second piece of that puzzle really comes back down to the fact that they're trying to stop those inflation speeders. And those inflation speeders really are the hardships right now. When we have those two things happening, so we have a slowing of inflation, which we're actually starting to see now, and we have a slowing of growth, which has basically been happening all this year, we really start to understand that this is not necessarily going to end well. This is not necessarily going to end in just a few months. This is a progression that we're going to be on for many months. And when we take a look at the data, when we take a look at where we're going, I call this the lead environment, the Lion's Wealth economic and activity development stages, and we have 1 through 4. Number 1 is saying that we're in a great place of growth with our economy. Number 2 says we have a little bit of growth with some, a little bit of inflation there as well. Not a bad place. Number 3 says we are really starting to stagnate as an economy, but we still have inflation. And the 4th and last one, which is the worst, is lead 4, and that says we have a slowing of the economy and a slowing of inflation. Now, why that is so bad is because of the fact that if we are slowing on both of those standpoints, that's where economies go to die. Not a great place to be. And when we take a look at this, and I say when they go to die, yes, that can be dramatic, but that it can also be over a long term, so many years. It is true that economies don't bode well in this environment. Well, the numbers and the data right now, so nothing else other than the numbers and the data and the math, suggest that coming into third quarter of 2022, coming into fourth quarter of 2022, coming into the first quarter of 2023, and coming into the second quarter, so that's 4 quarters total, the second quarter of 2023, all of these quarters, so that's 4 in a row, like I mentioned, are going to be in that lead 4 environment where we're going to have the slowing of growth. So that's where the economy is going to be restricted, or in the case of what our analogy was by the highway, constricted. So we're actually going to be narrowing the growth of our economy by putting those construction cones on either side. And that's going to stop those inflation speeders. So we're also going to start seeing a slowdown of the inflation, of where things are headed, and all of that is not good when we want to be growing the economy and seeing things vibrant and thrive. Well, when we talk about it that way, and we have 4 quarters that we're coming up upon, that also means that the stock market is not necessarily going to continue to keep growing over time. We are much more likely to see a sideways movement in the markets. So basically what that means is we're not going to go up very much, we're not going to go down very much. We may go a little bit more sideways. Well, that also means that we could be seeing another leg down in the market as well. You see, what we call these are bear market rallies. Bear market rallies can be really good and motivating to say this is the next leg up in the markets, I need to get invested for it. But on the flip side, they are just kind of a relief a little bit from the really stagnant, persistent type of environment that the stock market can be in. That is bad when those things happen. Now that is really where we're at right now, and we will not necessarily know kind of where things go, if this is the new leg up in the stock market or if it's a bear market rally, until we go through it. That's always the case. So when we take a look at the numbers say we have 4 quarters that we're at the minimum going to be in this environment of persistent hardship with our economy. That doesn't say that we're necessarily done with the stock market going down. Well, like I said, doesn't necessarily mean that the stock market is going to keep going down, but doesn't mean that we're done or finished with it going down either. So that goes back to what we talked about right away, how to risk manage. When we look at risk management, when we look at where the economy is going, and also when we look at the consumer, you and I, how you and I can be looking at all the different environments that are out there, the things that are happening with others, and how we have multi-decade highs for people putting just standards of food, gas, just bare necessities onto their credit cards, and having those credit cards skyrocket in what we call the revolving credit. So we're putting multi-decade highs amounts of money on our credit cards. All that says most likely the growth that has been happening in our economy is not sustainable. So if we're contracting or constricting our economy, plus we're still trying to go fast as a consumer, we're still trying to be doing those weaving in and out of the other cars, still trying to go faster through the road construction, that is a recipe for disaster. And if this continues to happen, we will basically see the consumer stop spending. And if they stop spending, then a lot of companies are not going to do well. And if those companies don't do well, then the stock doesn't do well. If the stock of many companies don't do well, then overall stock market does not do well. So it's a snowball effect that starts to happen. Well, what can we do about this? There are many things that actually have not been working this year for 2022. And when you think of what's normal for this environment, we should see bonds work really well. but they haven't. They have fallen just the way that stocks have. You should see other areas like gold start to work very well. But up until now, it hasn't. It's been more just stagnant, just there. There really has not been a lot of pockets of places that we can be invested other than the US dollar. You see, even though inflation is there, there's still some great aspects and great reasons to be invested into the US dollar. The first and foremost is the fact that Europe is doing horrible. Europe, well, they were on a 2-lane highway for a long time with their economy. They expanded it to a 4-lane over the last couple of years. So not the 8-lane that we have here. They're just on a 4-lane. Now they've already constricted it back down to a 1-lane. So there's a lot less room for Europe to grow. And if it really comes down to it, they're actually going to be just closing the road altogether. That's where Europe is at. So their versions of the Federal Reserve are going to be constricting things to the point that they may not actually have growth and may actually stop all growth in their economy. Well, that's to fight inflation. They have some of the worst inflation they've ever seen. So when we talk about it that way, the fact that they are not doing well, when we talk about the fact that China was coming into this third quarter of 2022 actually supposed to be doing very well with their economy, and then all of a sudden they're starting to see things not go so well. And the one thing we know about China is that they fabricate all of their numbers. But what happens if they can't even fabricate good numbers anymore? That does not bode well for the rest of the world. If they are the number 2 economy and they can't even sustain a fabricated number, that goes to show you that things aren't going well for other areas. And there's a lot of countries that trade with China, and those countries are not ordering as much. Those countries are not doing as well either. Well, then we also have to talk about Russia and Ukraine. It's been a hardship this year for them, especially for Ukraine and what's going on there, because anything that is happening with Ukraine, if they are winning, they're still destroying their country. If they're losing, they're giving up their country. It's a lose-lose for Ukraine, and especially for the people there. And it is a lose-lose for Russia as well, in the fact that not every Russian citizen wanted to be a part of this war. But what's starting to happen now, this is a land grab. This is really starting to say that they want to affect the flows of raw goods, of commodities, of all of these things through Ukraine. And they want to make sure that they control them for the future. Well, that is not really beneficial, saying this is going to end quickly. Whether we're saying that Ukraine's winning or whether it's Russia winning, this is not going to end quickly. And if they, meaning Ukraine and Russia, affect the world's population for a lot of fertilizers, a lot of wheat, a lot of things that we need for just food in general, it's not boding well that inflation is going to be gone anytime soon. And if inflation is not gone and finished and back down to a level the Federal Reserve wants, that also means that they're not going to be stopping that restriction of our economy anytime soon. So that is the kind of the big picture. Now I have one question I want to propose to you. Here it is. Are we really coming into an environment of growth with the stock market, or are we going to see the next leg down in the stock market? Now, why I pose this as a question is because of 2 charts that we're seeing here. The first chart right now is talking about how we are basically really on the cusp of another leg up. And if we take a look at presidential cycles, so if we take a look at the 4-year presidential cycles, and going back to 1950, we've put together every single year and really worked on the details there to say this is what, on average, every single year of a presidential cycle looks like. What we see in this chart is now, today, is a great great opportunity to start buying into stocks. And if history is going to repeat itself, this is going to be the next leg up in the stock market over time as well. So we really want to be in an environment of purchasing, saying the bottom is in, and to really be aggressive in our purchasing into the markets as well. So that is one view that is there, and it's not a wrong view. So hear me say that this is actually a very good indicator of what's to come. On the other hand, let's take a look at this chart, and I really do have to apologize for the graininess of this chart, for just the ways that it's not exactly that easy to read. But what this chart shows is 2006 through the middle of 2008, and then we overlay 2020, 2021, and where we're at today in 2022. So you can see we're talking about 2.5 years, and we're just comparing and contrasting them. And what this chart shows is that we are almost identical to where we have been 2006, 7, and 8. And if history is an indicator there, the next leg should be a down movement. Now, because of that, we don't know, like I said, if this is going to be a 2008 redux or if this is going to be the next leg up. So I want to pose that question to you, and I want you to be aware that there's some divergence that are starting to happen. But I also want you to be aware of the fact that the economy is different than where it was in prior cycles of the presidential cycle and prior cycles of where we were in the business cycle, say back in 2006 and 7 and leading into 2008. So is this time going to be similar to the presidential cycles and we need to be purchasing? Or is this time going to be just like 2007 and 8 and it's going to be a lot more hardships to come? So which is it? Are we going to be growing in the stock market and this is our new leg up? Or is this just a repeat of 2006, 2007, and then the start of the fall of 2008? That is where we don't know yet. But what we do know is the fact that there's a lot of hardships that we have not seen in the better part of 40 years with inflation. There's a lot of hardships that we haven't seen in the better part of about 25 years with our economy. And all that tells me that we're not out of the woods yet, and that risk managing your hard-earned wealth is going to be the name of the game for the foreseeable future. Feel free to reach out. I would love to talk to you. I'd love to talk about your plan and make sure that you are in a great place coming into the end of the year and making sure that you are correctly risk managing your wealth and that you have a great wealth plan in place for not only today, not only tomorrow, but the future. I look forward to seeing you soon. Take care.